Welcome, everyone, to another episode of Financial Clarity, the podcast where we break down complex economic topics into actionable insights you can actually use. I'm your host, Alex, and today we're diving deep into a subject that affects every single one of us, often without us realizing it: the U.S. dollar.
And I'm Jordan, financial strategist and writer. I've spent the last decade studying markets, and let me tell you, the dollar isn't just some green paper in your wallet. It's the epicenter of a global financial web, touching everything from the price of coffee in Rome to your mortgage back home.
Exactly, and I think most people don't pause to consider just how central it really is. Its value isn't static, it's constantly moving, influenced by a mix of policy decisions, economic data, and global events. So, Jordan, maybe let's start with the big picture. Why should someone care about the dollar's fluctuations today?
Right, that's a great starting point. The dollar sets the stage for the cost of goods, the yield on investments, even interest rates you pay on loans. So whether you're buying imported electronics, traveling abroad, or investing in U.S. stocks, these movements directly impact your finances. Understanding these shifts isn't just academic, it's empowerment.
Yeah, it's like knowing the currents before you sail. And speaking of currents, let's talk about the first major force shaping the dollar, the Federal Reserve. You call it the guardian dragon of the global economy, right?
Exactly. The Fed, especially the FOMC, wields its most powerful weapon, the federal funds rate. When they adjust rates, they're not just tinkering with numbers. They're directing the flow of capital globally. A hike can attract international money, strengthening the dollar. A cut is supposed to do the opposite, but, and here's the twist, the context and messaging matter just as much as the rate itself.
Ah, that's the hawkish cut term I keep hearing. It sounds like an oxymoron. Can you unpack that?
Sure. So recently, the Fed cut rates, which on the surface should weaken the dollar. But the way the committee communicated this cut was cautious, almost restrictive. They signaled no guarantee of further cuts soon. The market interprets that as maintaining tight conditions, which actually attracts investors and strengthens the dollar. So the dollar rises, even though rates fell. A classic hawkish cut.
It's fascinating how much psychology comes into play. So it's not just the number itself, but the story the Fed tells about the future.
Exactly. And this is where experience and attentiveness pay off. Reading the headlines isn't enough. You need to dive into the minutes of the FOMC meetings, look at the rhetoric about data dependency or future adjustments, because that's where the real signals are.
That makes me think of a metaphor I like. Credit and interest rates are the car's accelerator and brake. The Fed presses one or the other to steer the economy.
Perfect analogy. High rates act as the brake, slowing down inflation, strengthening the dollar. Low rates are the accelerator, encouraging spending, but often weakening the dollar. The recent cautious cut shows they're trying to steer very delicately to avoid a recession without overheating inflation.
It's almost like walking a tightrope. Now, aside from monetary policy, the health of the economy itself, employment, inflation, also plays a huge role, right?
Yes, the economy is the mirror the Fed looks into. Let's talk inflation. Most people watch the CPI, but the Fed prefers the PCE core. Think of it like dieting. CPI is total weight, PCE core is body fat. It filters out volatile items like food and energy to give a clearer view of underlying inflation.
Love that visual. And the labor market is another mirror. We've had softer job growth, yet the service sector remains strong. So it's not about alarmist numbers, but context and trends.
Exactly. Markets hate uncertainty. Predictable data stabilizes expectations, and stability is the dollar's best friend. So a single low employment figure isn't a cause for panic. You've got to look at trends and sectoral strength.
Got it. Let's pivot to fiscal policy. the debt monster, as you call it. How does $36 trillion in federal debt affect confidence in the dollar?
Big question. At that level, the U.S. faces what some call a fiscal event horizon. Investors start asking if the U.S. can repay without devaluing the currency or raising taxes aggressively. Even with Fed cuts, Treasury yields are up because the market demands compensation for the perceived fiscal risk. So long-term confidence is gradually eroded.
So even if the dollar is strong now, there's an underlying fragility.
Exactly. And political instability adds volatility. Threats of government shutdowns or debt ceiling clashes shake trust. Remember, trust is the ultimate pillar supporting the dollar.
Let's bring in a geopolitical lens. De-dollarization, CBDCs, how are these shaping the future?
Well, the dollar's role as a reserve currency has been its greatest asset, but rivals and allies are actively seeking alternatives due to sanctions and geopolitical conflicts. Central bank digital currencies, or CBDCs, are changing the game too. Countries like China are advancing digital payment infrastructures that bypass the SWIFT system, slowly chipping away at the dollar's dominance.
Historical analogy moment. Sounds like Rome. Internal debt plus rising external competitors eventually led to a decline. The dollar is facing a similar two-front challenge.
Exactly. But for smart investors, this is a chance. Currency diversification, exposure to stable foreign markets, even gold, these are ways to hedge long-term risks.
Before we wrap up, can we give our listeners some actionable tips?
Sure. First, monitor Fed rhetoric, not just rate headlines. Second, don't panic at one data point. Look at trends in inflation and employment. Third, diversify. Consider global assets, emerging market exposure, or safe haven commodities. And finally, think long-term. Geopolitical shifts are slow but impactful.
I love that. Knowledge isn't just power, it's financial protection.
Exactly. Once you understand these pillars, monetary policy, economic data, fiscal and geopolitical risk, you move from reacting to planning. You stop being a spectator and start steering your financial ship.
Perfect. Jordan, thank you so much for breaking this down. To our listeners, understanding the dollar is more than numbers. It's about seeing the patterns, anticipating shifts, and making informed decisions.
Thanks for having me, Alex. And to everyone listening, take this knowledge, reflect on your own portfolio, and take action. Even small adjustments today can pay off in the long run.
Absolutely. That's a wrap for today's episode of Financial Clarity. Stay curious, stay informed, and until next time, keep steering your financial journey with confidence.